Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good. We're all packed up and ready. It's our 10-year wedding anniversary. We're heading, our flight leaves at 5 a.m. tomorrow morning for Cabo San Lucas.
Very nice. Have fun.
Thanks.
Well deserved. Congrats, Rob.
Thank you. And guys, it's Memorial Day weekend, so what are you guys going to do?
Yeah, our family, we're just hanging out around home, or at least around Minnesota, kind of all over the place, really, but mostly just with family and friends, trying to get outside, enjoy some sunshine, hopefully, if it doesn't rain too bad.
Mm-hmm.
Yeah, same. Just trying to get some time with family, time in the sun. My in-laws have a boat from the 1980s. Still works, still kicking. And maybe we'll get out on the river and enjoy some time on the sun. Yeah.
Fun.
John, what river?
It's the St. Croix River. It's the
St. Croix
border
River.
between Minnesota and Wisconsin.
Yeah, fun.
Nice. Well, guys, this week we're talking about how the infinite banking concept got started. And of course, we've been going through Nelson Nash's book, Becoming Your Own Banker.
Mm-hmm.
Guys, as we cue off our conversation today, Nelson breaks down the infinite banking concept, and he kind of thinks of it in three lines of thought. The first one being forest finance, the second being dividend-paying whole life insurance, and then the third being related to Nelson's exposure to the real estate business. When we're talking about forest finance, none of us are foresters here, so let's try to break this down for the listeners. What is forest finance, and what are some of the aspects of it that Nelson thought would be really practical when thinking about the infinite banking concept?
Well, we'd be remiss to not mention that it requires you to think long-term. We say it over and over again. I think already we've said it about 5 times throughout our few episodes already, but we got to say it again because that's deeply ingrained into this concept. And it's because of his background as a forester, thinking 70 years, multi-generationally, and his experience in the beginning of his career. That's what he studied in college, really affects the way he views finance as well. And he talks about the fact that you are dealing with compound interest over a long period of time, like I said, 70 plus years. And then my favorite part about that sentence in the beginning of page 12 is with no taxation on the buildup. We're not compounding our growth and thereby compounding our tax in this strategy at all.
Yep. Yeah. The one of our main mentor, Dave, I hear him say this quite a bit, that life insurance policies, for those of you who think this sounds like a good idea to start a permanent whole life insurance policy to become your banking system. Just like planting a tree, the best day to have done it was 20 years ago. The next best day is today, because it takes it's a long-term vision, right? It's capitalizing over the long term, just like Nelson as a forester would think long term. So, start today, start now, and then just start slowly building up your system, filling up your creating your banking system, and so get going.
Yeah, I liken it to say that it's not a get rich quick scheme. This is something that you can get wealthy over a long period of time, transfer wealth to the next generation, of course.
Yep.
And the tool that we utilize to do that, not our secret here, is dividend-paying, mutually owned whole life insurance.
Mm-hmm.
Now, in this episode, guys, we're not going to get into too much of the nitty-gritty of mechanics behind it, but just to say that Nelson was a life insurance agent, and he spent loads of time trying to get a good understanding of how whole life insurance works. And the best way for a consumer or one of our listeners to learn about it is, one, they could pick this book up or several of the resources that Nelson had a hand in playing. But of course, working alongside an authorized IBC practitioner to make sure that their policy is going to function the way that this book teaches and describes. So without getting too much more into the whole life insurance, why don't we just go ahead and move on to the real estate side? And even in today's world, you see investors clamoring for real estate, and people think that it's going, they hear great stories of most millionaires in America build their wealth through real estate. Let's talk about that. Both of you guys have some exposure or had some experience in the real estate market. Tell us a little bit about that experience.
Well, one of my experiences is I had so we were right before we started the recording, we were talking about how applicable this book is. This was written back years ago, but it's really applicable to now because the interest rate climate has rapidly increased over the last few years. But the insurance, you're taking policy loans from your insurance policy is a great way to help buffer that time and how things can change so quickly. And so I had a rental property that I had a line of credit on. And when the market, this was back in the 2008 era, and when the market crashed, then the bank just told me I can't, they didn't call my line in, thankfully, but they said it's frozen. I have to pay in, but I can't take out. And so if you're involved in the real estate industry and you don't have a buffer, like your policy, like you're taking a policy loan from your life insurance, then you're kind of stuck. So one of the advantages of having the policy is that then you could take a loan out at a lower interest rate, pay off that higher rate line of credit, and help weather those storms. So that's a personal real estate example that I had in my life.
Yeah, this experience that Nelson had is really interesting to think and put myself in his shoes. And I think just real estate in general is fundamentally attached to banking. It's fundamentally attached to borrowing for the most part. I don't know of a single person who has a huge portfolio of real estate properties, say rentals or commercial, without having some sort of banking attached to that.
Yeah.
And Nelson's experience, where he had, again, like Rob said, very similar rates to what we're experiencing now, and then all of a sudden, in a short turnaround, the rates climb up to the 20s. And since he's not a prime customer to these banks, he gets the prime rate plus a margin. So now he's expected to pay this 23%. I think mortgages at the time were in the teens, 12 to 15%. But he's expected to pay far, far more than he planned to do. And that definitely probably eats into his cash flow, and something that just comes out of nowhere, where I think real estate's great. I think it can appreciate over time. I think many, many people have seen the explosion of the real estate market, especially, during COVID. Lots of people were able to profit, but it all does come with strings attached, which is the banking function. And like Nelson experienced, like you experienced, Rob, thankfully, fingers crossed, I have not, run into a situation where the bank just totally flipped the terms and now I'm in a rut. But that very much could happen, as long as I'm associating myself with commercial banks. And so I think just Nelson's experience shows us that the banks can very clearly change things up on you and change your entire cash flow picture, your entire profitability of your real estate transactions. So controlling the banking function is huge. That's what we're here to teach. That's what we're here to implement for people, is to establish your own little family banking system to meet and exceed your needs, so you don't have to be subject to sudden changes in banking terms.
Yeah, the financial gurus or financial geniuses out there today want to preach about using leverage. Yeah. And that's, it's so common that people don't even stop to think or rethink what are the potential pros or cons of using other people's money. It's just touted as the gold standard. This is the best thing you could do, is utilize other people's money. Think about it. You're going to generate a near infinite return. Well, in Nelson's experience, yeah, the leverage that he had, leverage cuts both ways. It can help you, certainly, but it can also hurt you if it goes against you. And he went from getting used to paying 9 or 9.5% on a loan to now it bumps up to 21.5%. And that got me to think. This week I had a call with a potential client, and he was talking about his credit card debt. And the interest rate he was being charged on his credit card debt is at 23%. And credit card debt is at an all-time high in this country.
Wow.
And here we have a tool to help people recapture the interest that they're sending out just willy-nilly to these credit card companies. But at the same time, we need to teach people to be prudent about their finances and to have control over their finances. There's another instance here that really affected Nelson's life during this period of time in the 80s when he discovered the infinite banking concept. And that had to deal with a family member and illnesses. Do either of you care to speak a little bit more about that?
Well, in the book here, Nelson says that his awakening was November of 1980. So I think that's a good thing for our listeners to remember. Like that's when this concept, when at least Nelson credits this concept being kind of officially in his mind as a thing. But it was during this time where his granddaughter got cancer as a baby, real young as a newborn, basically. He had those humongous interest payments going on in his life. His brother passed away, playing racquetball with his son at 52, I believe it was. Just so a lot of tragedy and stress. And then he had all these interest payments that he could not afford to pay. And one of my favorite lines in the book is, he says, the basic idea revealed in the infinite banking concept was born over a period of many, many months at 3 and 4 a.m. in the kneeling position praying. So I just love this picture of Nelson and his faith, but just, going to God when he was in this time of trial, and then, God revealed to him, you're standing in the midst of everything it takes to get out, but you don't see it because you look at things like everybody else. And I think the key there is it's such an eye-opening moment when you realize you have all of those resources that your permanent life insurance policy and the cash value buildup gives you, and how you just think differently. You can leverage those to your advantage instead of having to always be at the whim and the will of the banking systems out there external. So I just think that's such a couple of key points there. Points to Nelson's faith, points to the trouble he was in at the time. It points to the revelation that he could use these life insurance, high cash value life insurance policies, paid a lot of premium into them. He could leverage those to weather these financial storms, break free of the system, and control his own financial, destiny, so to speak.
Yeah, I see it as just kind of the fragility in life and in his experience and your experience, Rob, banking as well. Like, it's totally out of our control. And with life, he talks about his brother and his granddaughter, and that not even your health is certainly not guaranteed. The only thing that is guaranteed, I suppose, is that we are all going to graduate, as Nelson talks about. We're going to pass away. And IBC addresses that fragility and actually provides protection and certainty, and something that we can't really find many places outside of dividend paying whole life insurance is guarantees, contractual guarantees that, with his experience in life insurance, with his experience in real estate, he's able to compare and contrast in real estate, I have this 23%, payment. And in life insurance, I know I have this contractual guarantee. And this not only addresses the banking function, but it addresses the fragility of life and the fact that our health is not guaranteed. Our days are not guaranteed. That is all in God's control. And he understands that. We understand that. And I think everybody, to a certain extent, knows that. It's just a matter of addressing that and finding the best solution. And dividend paying whole life insurance, and especially using it for the banking function, really does address both aspects of the lack of control and lack of guarantees that we have, both in life and in banking, obviously, is what we're talking about. So, and yeah, no, Rob, I totally resonate as well, that the fact that this concept is born out of a posture of humility and a time where he's seeking wisdom from God. The New Testament and Book of James, you want wisdom. If anybody lacks wisdom, let him ask and he'll receive it. Ask with faith. And it seems like he actually really did. And God answered his prayer, which is really sweet to see. And as a Christian and as someone who trusts that God does provide wisdom, that's really comforting to know that this wasn't just some like gimmicky like concept that he's just going to go out and just push life insurance to everybody under a different title of infinite banking.
Right.
But it's a concept that was near and dear to him, that he was vulnerable enough to share with everybody, and committed enough to, after 20 years of practicing it, like you said, it was founded in the 80s. The book came out in 2000. He showed this proven concept of how it worked in his life. And he talks about in a later paragraph that his income nearly tripled from this benefit. So he's able to just share the personal anecdote to address these non-guarantees and fragilities in our lives.
Yeah, one thing that we wanted to get across to our listeners in this episode, there's a line, Rob, where he says that you're always dealing with borrowed money.
Yep.
Tell us a little bit about that, and then John we'll talk about being a slave to the lender as well.
Yeah, I think that's one of the key points in Nelson's book that was a big revelation to me when I was learning about this process. Because I always thought that cash on hand, instant liquidity from my bank account or in a drawer, couldn't beat that, right? And because if you were going to a bank, you're paying interest for it. And so I always thought cash was the right way to do it. But so this was a really big epiphany that I learned by going reading through this book and digging into it. Because it struck me, like when he said, you are always dealing with borrowed money, always dealing with borrowed money. You either borrow money and pay interest, like you go to a bank and you get a loan, you're paying interest, or you use your own money, the money I had, in a coffee can in the closet, or in a 2% savings account or something, you use your own money and give up interest that you could have earned. And so that was really an eye-opening moment for me, because so many people think the best way to pay for everything is cash. Well, I was just taught that, well, there's actually a better way. A better way is to put your cash into a permanent whole life policy, which is guaranteed to always grow, and then leverage the cash as a policy loan, which then becomes cash that you can use. And the cash then doesn't leave your hands forever. It's still growing in your policy. So you get your dollar's doing two things. It has two jobs. It's growing in your policy, and now you just used it to purchase an asset or purchase something that you had a large purchase. And so that cash has never gone out of your fingers and gone forever. And so that was really that lends to that economic value added, that your cash has a price. The bank charges you to use your own money. You need to recognize that your own money has a price. It has a value. You need to value it. And a way you can capture that value is by putting it into a place that's guaranteed to always grow, that you can leverage and never interrupt the compounding. So that was just a huge epiphany moment, that concept that Nelson was trying to drive home in the book.
Yeah, let me add a third job that dollar is doing. It's protecting your family. and giving you life insurance, giving you a death
Right.
benefit.
3 jobs. Give your dollar 3 jobs. Good point.
And the proverb talks about, I don't know the exact reference honestly at the top of my head, but the borrower is a slave to the lender. And our stance, we do not think it's immoral or a sin to have any sort of bank loan or bank debt. But what we are going to expand upon on that verse is just that with the nature of what Nelson did with his 8% increasing to a 23%, he's subject to those terms. He is, the slave equivalent is he's bound by contract to pay the interest that's going to be determined by the lender. And what we want to say with regards to that and how it relates to IBC is that you can be both. You can control both while your money's growing, by the way Rob just talked about. But you can be the lender to yourself from your own bank and charge your own interest. And we can talk about later and how the book talks about it, that it's in your best interest to charge at retail rate or greater. But you control that, and you have the flexibility to control that, and you have the flexibility of the terms of when that's paid too. So you get to become the primary beneficiary of the banking function to have that control.
Let's talk a little bit more about that, right? If we take out a policy loan, who are we paying interest to?
You're paying interest to the insurance company. When you
Okay,
take out a
so
policy loan, you are taking out the insurance company's money, and you are paying interest back to the insurance company.
So am I more of a slave or less of a slave to borrow from an insurance company versus a commercial bank?
Oh, you are less of a slave.
Yeah, and those rates aren't going to go skyrocketing up to the 20s.
Yeah, so let's dig into the details as to why borrowing from an insurance company is more favorable for individuals or families than a commercial bank. I'll just list off a few. John, you had already just said that there's restrictions on how quickly an insurance company can adjust the policy loan rate. In fact, they can only tweak it once per year, and it will occur on the anniversary date of your policy. Now, that loan rate is a floating loan rate. It can change from 0%, but it's got a maximum of 8%. And even today, I've recently taken out a policy loan. I believe I'm getting somewhere between 5.2, 5.5%, which is still well below a prime rate at a bank.
Mm-hmm.
And so I've got control over when I make my payment, whether it could be monthly, could be quarterly, could be annually. It's up to me as the borrower. I've got more freedom and less risk tied to the interest rate because the insurance company can only tweak it once per year, and there's a cap, there's a maximum that they could charge. And just so our listeners are aware, the last time they were up at 8% was back in the 80s and 90s, shortly after Nelson had this epiphany here. And what were people who were well capitalized with whole life insurance doing? They were borrowing from the insurance company and purchasing CDs and bonds because they were yielding 20%. They were making a spread. They were banking with their money because the market, the environment that they were in, was very favorable to that at that point in time. What are some other attributes or aspects about borrowing from an insurance company that is different than a commercial bank? And how does it make us less of a slave?
Well, I have a question for you, Derek. If the market crashes, will you still be able to take out a policy loan?
Yeah, I have complete contractual rights to the first person in line for the cash value in my policy to go to the insurance company and say, I'd like a loan, please send it to me.
Yeah, and I think that's just so powerful for people to, if you're a real estate investor and you build up sizable cash values in your policies, you have access to that cash whenever you need it, no matter what the market is doing, up or down. It's not a decision on the insurance company to allow you to get a loan. It's part of the contract. You can get a loan whenever you want from your policy at any point. They don't ask you what it's for. They just say, how much do you need and where do you want us to send it? And so just so you know that you're never going to be limited by the market. And that's that gives you freedom and peace and security to know that I don't care what the market does. I don't actually care what the market does. You need a loan for something, you just call them up and say, I need it.
And on that market crash, if you're going to get a loan based on the value of a property, you just lost 20, 30%, in 08, market values and property values just tanked. And you're just stuck with the value that just dropped. And if you're trying to get a loan or if you're trying to secure money based on the value of that property, the bank is not going to give you that favorable terms, favorable amount. But you could always guarantee that your cash value is going to grow. And you can always guarantee that the terms are going to be favorable to you and to your banking system.
Mm-hmm.
And they can't freeze your credit line. They can't at all take back what they've loaned to you.
What limitations can the insurance company put on us as policyholders? What are we restricted by?
How much you put in? You want to write a check out of your checking account? What are you restricted by? How much is in there? How much you've put in? How much you've deposited? In the same way. That's why a lot of people in the IBC community consider premium payments or premium bills to lots of people in the world. We consider them premium deposits into our bank.
Yeah, I can't wait for my annual premium deposit, because that means I have more cash value that I can leverage because I'm buying more death benefit. So yeah, I look forward to premium deposit day. As everyone who actually does IBC with how we're teaching it, everyone looks forward to that day, because that's when you get to put more money in your bank.
Yeah, and guys, even the way that we will or have the ability to structure a policy, we have the ability so that someone, if they wanted to, could pay premium for a long, long period of time, up till age 95. Why would somebody in their 90s get excited about making a premium payment if it's an expense during retirement years? Why is that something that they should jump for joy over?
Man, all you gotta do is look at an illustration, because at that point, especially, like I'd say for two reasons: inflation and illustration. Because that premium you started paying 30 years ago in 30-year dollars is so small compared to what the dollars can buy you when you're at 95. But the amount of money you get back for each premium you pay when you're at that end of the scale is just, you're getting 3 times, 4 times the amount of money you're putting in for every dollar you get. So you could be, let's say, 10 grand, you might be getting 35 grand back in cash value or something like. It's huge. Those are the days you want to be putting money in, as the policy gets more efficient later in the years that will be going on.
Yeah, it only gets better the longer it's in force. So, I'm in my late 20s, and if I can make it to 95, number one, praise God for a long life, and I'm thankful for that. And number two, I'm thankful for my premium dollars. Yeah, probably at that point, 6, maybe 7x what I'm putting in.
It's amazing.
And it's all growing and compounding at a tax-free basis right there. And even when we do pass away, not if, but when, that it's transferred to your loved ones when they need it most. And it's been a great tool for you that you've been able to utilize and leverage during your many years of life. And then now you have that ability later on in life. Yeah, put $1 in, you see that cash value grow by 5 times maybe. It obviously will change based on how long those premiums have been paid, but that's why so many clients are getting excited about, yes, I want to pay that premium expense or bill, like you say, John, in retirement, because look at how much more cash value I'm going to have that I could utilize for other investments, or could withdraw out of that policy at a tax-free basis and utilize for retirement income.
Yeah. Yeah. And
And I
I'd say
want to
just,
speak to
go ahead,
Nelson.
John.
Yeah, I want to speak to Nelson's confidence and um, just principled nature in the second to last paragraph on page 13. Very simple sentence. Practically everyone thought I was crazy. It was the opposite of what all the experts said. And there are experts in the financial world who think IBC is a scam. They think it's the worst decision. It's financial crap, they say. And it's just uh, people will think if you practice IBC, you'll very quickly realize people think it's crazy.
Mhm.
Like life insurance is a waste of money, especially whole life insurances. You're just throwing money away. But if you actually observe the facts, actually like see the contract that's guaranteed to you, and like Rob said, maybe later down the road you're able to like study the illustrations, like you can see that it just makes sense, just plainly makes sense. And we can coach you through that, but still just most people don't practice that. And that's okay. Like it's okay to go against the crowd, to go against the um, conventional wisdom that we've been taught. Because the truth is, the majority of America doesn't have much in savings, doesn't have a real strong position in their personal financial picture. And largely that's due to following the conventional wisdom that is generally taught. So if that's the case, then maybe going against that is the right thing to do.
Right. Right. Yeah. Do what I just heard someone just mention that too. I shouldn't even refer to it because I'll get it wrong, but it's basically, if the experts have been right for the last 30 years, why are so many people in so much debt? Right? If the experts are right, why is everybody in debt at historic levels? Think about that for a second.
Because the rates were so low, Rob.
And the experts themselves are in that same debt as well.
Yep.
But
well, there's maybe one other spot that I think we should probably touch on here, guys, and that has to deal with that second to last paragraph there. Nelson says at the top of the page, if I had not been accustomed to paying very large premiums, it is doubtful that I would have seen this message. And later on, he says, honest introspection revealed that I could revise my spending pattern, and this was the starting place. What are your guys' thoughts on that? What did Nelson mean by it? What are some things that we can learn from his example here?
Talking to prospective clients, one of the main objections or even just maybe concern that I see come up is, oh, well, I can't pay that much premium. I can't, right now I hardly even pay $200 a month for my term insurance. There's no way I can pay, 10 times that annually or something, The big concern that I get is that they're just unable to find the dollars, at least from their general snapshot of what their budget looks like. But like Nelson talks about, a true introspection and an evaluation. And that's something I think we're good at, is finding where those dollars are going and where they can be redirected or sequenced. But I think finding ways to pay the high premium without it, changing your cash flow or causing any more stress, I think is something we're skilled at, something we've done ourselves, and can help solve for the banking function quicker, because then you are used to paying those large premiums and you start to accommodate for all your banking needs.
Yeah, I was even, going back to that example of somebody being in credit card debt and paying 23% interest. They may be scratching their head thinking, how in the world am I going to pay X amount in premium? Well, it's because you're in such of a terrible debt situation.
Yeah.
Where you're sending a third of your take-home pay is going directly just to interest, not to principal, just interest payments. That's where we can recapture. That's how we redirect this. You have to realize that, yes, it is going to take it a period of time to capitalize. But once you've got a system that's been well capitalized, now you can redirect that. And all of a sudden, you start seeing all these things that you were financing in life, and it was just money going to line the pockets of these bankers. And now instead, we're wanting to reline our pockets. How do we build a system that acts like a bank so that we can recapture the interest in the debt that we were paying to other people? Well, guys, any other thoughts here for this episode for our listeners?
Nope, just love these pages of the book. Just looking forward to going through them each week, and just the knowledge and the wisdom that Nelson has is just, I can keep reading it over and over and over, and I do.
Yeah, this is round, I think 5 for me, and I read it not too long ago. So we love it. We just can't wait to continue through the book.
In the next episode, guys, we're going to be talking about imagination, reason, logic, and prophecy. One of my favorite topics is to think about imagination and how our lives could be different if we just think like a bank and design a system like a bank. But until then, guys, I want to wish you a happy Memorial Day and hope you enjoy some time with family and friends.
Yeah. Thanks, guys. You too.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.